The broadcast is now starting. All attendees are in listen-only mode.
All right, guys, good evening, everyone. This is Neil Green again with you on the weekly webinar. Just want to check that everybody can hear my voice and see the screen. You have a chat window. So if you have any questions during the webinar, you're more than welcome to write me down. Hope everybody is doing well. And so just write me down. Can you hear my voice? Can you see the screen? You're supposed to see our homepage at itrader.com just before I start. Want to see that we're good, and just write me down that you can see the screen and hear my voice on the chat window. And I want to wait for about a minute or two for everyone to arrive. So let's wait for a minute, and I'm going to be back with you. Okay, guys, Neil Green again with you on this weekly webinar. Hope everybody's doing well. As I said, you have a chat window. Any questions during the webinar, you're more than welcome to write me down. And we're going to talk actually today about the biggest event in the market, which is the interest rate decision. The interest rate decision in the United States that takes place 8 times a year. And takes place 8 times a year, which 4 of them is followed by a press conference. Okay, usually when there's a change in interest rate, you can see it. It usually happens when it's followed by a press conference, and we're going to talk about how significant it is, how important it is to the U.S. market. The volatility, you have to understand, this is the biggest event in the market. Okay, it's going to take place, as you can see. The interest rate is going to take place tomorrow. Okay, so the Federal Reserve rate decision, the Central Bank of the United States, which is the strongest economy in the world, will take place on Wednesday, which is tomorrow at 6 p.m. GMT time. Okay, if you're from London, it's going to be around 7, mid-Europe 8, and so on, so check your clock. And it's going to be followed by a press conference at 6:30. All right, where can I see the results? You can check on our website or go to investing.com or Forex Factory, as you can see. Okay, Wednesday, you go to Wednesday. I put it on GMT time. You can set the clock to your time. And you see we have the FOMC economic at the statement and the funds rate. We have the funds rate, and then we have the press conference. All right. So interest rate in the United States right now is 1.75%, and we expect it to raise up. We expect a high to 2%. Okay. And let's talk about how it affects the market, because for us, when we see such a big event, we want to take advantage of these short-time trading opportunities in order to widen our portfolio and try to make some profit here. So the interest rate decision will take place at 6 p.m. GMT time. 30 minutes after that, we have the press conference when Jerome Powell, the head of the U.S. Fed, is going to talk about the decision. Is going to, for about an hour. Going to be a press conference answering some questions from journalists and so on. And usually the market affects very strongly to this press conference. A lot of important questions, and of course, more than that, a lot of important answers that we're willing to receive. So actually, when I trade this kind of events, I trade it in 2 waves. Okay, first is at 6 p.m. GMT time, I can trade the interest rate itself, which I'm going to show you how. And then you can listen on Bloomberg or any other channel to the press conference itself, and you're going to see the reaction of the market. Okay, very strong, a lot of volatility, a lot of volume, a lot of money coming in. And for us, guys, volatility means trading opportunities. For us as traders, what we're looking for is we look for this kind of trading opportunities. We look for this kind of events that the market moves strongly. And the Fed is expected, as we say, to raise its rate from 1.75 to 2% by 0.25%, which is the highest in many, many years. If you look at the interest rate in the U.S., okay, just for you to understand, let's take a look together. Interest rate in the U.S., you see, it's supposed to be 2%. If I'm opening a chart, you can see that after 2008, after the big crisis, interest rate on December 2008 was 0.25%. For a long time, the first time on December 2015, it went up to 0.5%, and then 0.75, 1%, 1.25, 1.5, and now for the first time 1.75. And here is the expectation for tomorrow for 2%. Okay, and let's talk about what assets it affects, because actually for us traders, this is what is important, because we want to look for trades. And as a trader, if I want to look for trades, I want to know these big fundamental events, especially the interest rate decision. What assets does it affect? Okay, where these assets are going? Does it go up or down? Should I go into a long position, a short position, and how do I trade it? So the Fed is expected to raise interest rate from 1.75 to 2%. Higher rates affected loans, mortgages, deposits, credit, and credit in general. Let's talk about interest rate. Okay, in general, if I would like to put it in other words, is the price of money, right? If interest rate is high, okay, let me ask you a question. If interest rate is high, is it good for the U.S. public? Is it good for the economy? Is it good for the people living in the U.S. or in the entire world? But is it good or not? What do you think? Do we prefer higher interest rate or lower interest rate? Any ideas? You have a chat window. You can just write me down. Any ideas? We as citizens, not we, I'm talking about the American citizens, do you think they prefer lower interest rates or higher rates? What will be your guess? All right. Right, it depends, exactly. It depends on if you're the one selling the money or buying the money, right? If I'm closing a saving account in the bank, okay, I would prefer higher rates because I'm going to get more for my money. Okay, usually higher rates in a country means that the currency, if the economy is stable, of course, and if it looks good, higher rates means that the currency usually is getting stronger. Okay, what is the reason for that? Think about it. If you want to invest your money somewhere, okay, you want to put it in the bank or wherever, you would probably put the money in a country that has higher interest rate. Okay, if the economy is stable, like in the US, which is very stable at the moment, okay, in order to get higher rates for your money, more interest for your money, right? So if interest rates go up from 1.75% to 2%, in general, we expect the US dollar to get stronger. We expect investors from out of the US to invest in the United States of America, and by that they have to buy US dollars, more demand for the currency, which means stronger dollar, stronger US dollar. And on the other hand, and U.S. banks, okay? Now think about it. U.S. banks are selling these loans and mortgages, right? Higher interest rate, which means the public are going to pay more for the loans and mortgages, okay, and for the credit that they take, which means it's great for the banks, higher interest rate, and usually good for the economy. The correlation between rates and currency is the strongest, as we said, okay? Average, if we talk about the main asset, the most popular asset when it comes to currencies, the euro versus the dollar movement on report is usually higher than 70 pips, okay? When we say more than 70 pips, guys, you gotta understand it's a big movement, high potential, all right? What I need to know in these fundamental events is to identify the direction where the market is going and trade it the same way according to the information. All right, 70 pips is a lot, okay? Huge potential in order to double our account or more. Major dollar pairs together with gold will be very attractive to trade. As you probably know, gold is safe haven, okay? This asset is actually works like some kind of a parking lot, I would say, to all main currencies, especially the US dollar. We have a perfect, almost perfect opposite correlation between the US dollar and gold, okay, which means when the US dollar goes up, gold goes down, and the opposite. Usually gold is getting stronger when we have a lot of uncertainty and a lot of issues, okay, in the world. So gold is getting stronger. Major dollar pairs, as we said, major dollar pairs, okay, the dollar versus the Japanese yen, the Great British Pound versus the dollar, euro versus the dollar versus the Swiss franc, whatever you choose, Okay, you can. The idea is for you to diversify your portfolio. Okay, guys, when you work, a smart trader is one that knows how to work with a big portfolio in order to diversify it. And then when we have such a huge event as the interest rate decision, the idea is not to put all the eggs in one basket, which means not take all your money in your portfolio and trade on one asset. It doesn't matter if the euro versus the dollar and so on, or whatever. You have a few pairs. Okay, if you look at the MetaTrader, okay, a few pairs that you can choose. Take a look. Okay, if I'm opening the MetaTrader, so I can trade on when it comes to the US dollar, euro versus the dollar, pound versus the dollar, dollar versus Japanese yen versus the Canadian dollar versus the Swiss franc versus the Australian dollar, and so on. You have so many ways and assets that you can diversify. If you go down here, XAU, all right, trading on gold. Where's the gold? You go here, you do show all, and it's gonna be okay. There you go. Okay, gold traded right now 1,295 per ounce. Actually, it went down. It was 1,302 after the meeting that we had today, the summit between Trump and Kim. You probably heard about it. Gold went down, less pressure. Usually, when we have a lot of tension and pressure, we say gold is a safe haven. It's getting stronger. And the opposite, this is what we saw today on the meeting, but just for you to know what's going on in the world right now. So we have major dollar pairs together with gold will be a very attractive to trade. I'm saying again, opposite correlation between gold and the US dollar. US banks could be also affected strongly from the event. Of course, higher rates is good for the banks. They give out loans, they give credit to the public, to the people. They give out mortgages for houses. Higher rates means the banks makes more money. Okay, and if you want to trade, and the US market actually is going to be open on the announcement, so you can even diversify more your portfolio, which means work with a bigger portfolio and trade more. And then looking at, if you look at the American stocks here in light green, we have Bank of America that you can trade, for example. We have JP Morgan, okay, Goldman Sachs, and so on, that you can trade. JP Morgan, there you go, and so on. Citibank, so it affects the banks as well. Okay, what is supporting higher rates and what is not? Inflation, okay, inflation means prices are going up, prices of services and goods as well, is rising in the US, which supports higher rates, all right? Strong NFPs are supporting higher rates. We have more than 2 million people, new payroll since Trump was elected. Okay, the NFPs, they look great. Unemployment rate is the lowest since 2001 or maybe more. As far as I remember, 3.8% in the United States. Great. Okay, last NFP was more payrolls than expected. Unemployment rate was lower, which is great. Average hourly earnings, we expected 0.2 increase by 0.2%. We had 0.3%. So the NFP showed us very good numbers in quality and quantity. More jobs and people making more money. U.S. stock indices are going up. Nasdaq, Dow Jones, S&P 500. Everything just looks great. Tensions. What can make lower interest rate, lower rates? Okay. So we're talking about tensions in Europe and Italy right now, support lower rates. Okay, we have a lot of tension in Italy with the Five Stars Party, with the elections. Nobody really knows what's going to happen there. Are they going to still be part of the euro and so on? So we have to check it out. And geopolitical tensions, of course, support lower rates as well. So just for you to know, what are the points that can support higher rates and what are the points that are supporting lower rates? Dollar and banks could rise if the Fed shows many rate hikes in the future. Now, people ask me, all right, how do I know? Let's say, for example, I'm looking tomorrow at this, all right? And I'm seeing, okay, the expectation is for interest rate to go up from 0.75% to 2%, right? That's what we expect. And then at the same hour, I'm checking the interest rate and I see that it's really 2%. So should I go with the dollar or against the dollar? And let me tell you a secret. Write on Google, countdown to FOMC by CME Group. All right, countdown, FOMC. You can write it down in a note. You can Google it tomorrow. Now, if interest rate is going to stay at 1.75%, of course, we expect the dollar to drop. And if it's going to be higher than 2%, which I don't believe, we expect the dollar to go up. We said higher interest rate is good for the currency, and lower interest rate goes against the currency. All right, and gold works the opposite correlation, the opposite way. I mean, opposite correlation between these two assets. Now, as you can see, we have here expectations for hikes by the end of the year. So I click on December 19th. December 19th is the last interest rate decision in 2018. So I click in here, and then I'm getting this chart, which shows me, okay, what are the chances, what is the probability, all right, for interest rate to go for 2 hikes, okay, from 1.75, which is now, to 2.25, okay, 44%, and we're talking about 37% that interest rate will go up 2 more times this year, not 1 to 2.5. So we expect it to go up to 2% tomorrow. This is the expectation. Now, if you look here, and after the publication and after the press conference, 30 minutes after the interest rate decision, you will see that this number, okay, that's 37% for 2 hikes by the end of the year, and the 5.8, almost 6% for 3 hikes by the end of the year are going up. We expect more hikes, should be very supportive for the dollar, and we expect gold to go bullish. Okay, and the opposite, if we see that the percentage for 1 more hike, which means 2.25% interest rate by the end of the year, we expect dollar to drop and gold to go up. Right, this is a major tip, guys. Not a lot of people know that, so you can write it down and use it. Gold could rise if Fed announce unstable conditions and less hikes. Of course, less hikes means dollar getting weaker, gold is getting stronger, US banks are getting weaker, and US stock market usually getting stronger. There's another opposite correlation between usually when interest rate goes up, it might affect the stock market to go down. It depends on the situation. Why? Because think about it, you have $100,000, interest rate is higher. You would put the money, right, in savings, non-risk in the bank. And then you have to sell your stocks because the money is sitting somewhere. And the opposite. If interest rates are lower, what I would probably want to do is take my money out of the bank and buy stocks. So countries that want to develop, right, they want the people to open more businesses, they want to take the economy forward. What they usually do is they take interest rate low, and then they make people go out, work, and do whatever. And the opposite, all right? Countries and financial entities, that what they want is for they want the banks to have higher revenue. They take interest rate up. Market expecting 95% chance rate hike now, and another 35% for another 2 in 2018, as I showed you. Traders can trade the market reaction. First of all, you have on 6 p.m. GMT time the reaction of the interest rate itself, and I show you how to trade it. And then close positions and open again during the 6:30 GMT press conference. According to what they're going to say there, Jerome Powell and the rest, I don't know yet, but you can watch it on Bloomberg and see the reaction of the market, all right? Traders are recommended to diversify their portfolio. We talked about it, very important, guys. When you trade in the capital market, okay, do the best in order to diversify your portfolio. Don't put all the eggs in one basket. I'm saying it one webinar after the other, and I'm going to keep saying that. Trade smart, guys. Don't take one way. Try to trade a few assets. Profit targets on currency pairs around 0.7% movement after publication, which means you can more than double your account using a leverage of 1 to 200. You need only 0.5% movement in order to double your account. And for bank stocks and gold profit targets, we're talking about 1.2% movement. And of course, good luck. All right. So if you have any questions, guys, you're more than welcome to write me an email or contact your account managers ASAP. Okay, they're going to be available for you tomorrow all day, since we have the interest rate is going to take place in the evening, the interest rate decision. For next webinars, all you have to do is go under news, click on webinars, put in your first name, last name, and your email address so we can contact you back. Don't forget tomorrow interest rate decision 6 p.m. GMT time, and then 30 minutes after that followed by a press conference. It will take around an hour. Wish you guys best of luck. Okay, trade smart, and good luck tomorrow and in general with your profile, with your accounts. And thank you very much for participating, and have a great one. Bye bye.